Afternoon, everybody. It is Kyle Heineman. It is about 12:30 Pacific time, Friday, May 8th. Just wanted to do a market update for you guys. Not several, kind of, I don't know, several dozen of you guys probably reached out to me in the last week to 2 weeks, and have requested a market update. I don't obviously like to do these very often, but felt like now would be kind of a good time with the way that the markets are moving. So again, this is going to be much, much, much shorter than I typically do, so it will definitely be less than 45 minutes because I have prior commitments that I need to get to. But anyway, I just want to go over some of the markets that you guys are likely interested in: metals, gold, silver, probably the S&P, Bitcoin, and some of the individual stocks. But as I often do, just like to kind of set the stage in terms of where we are, where we've been, and where we're going. So first and foremost, there's a lot of requests. There's always a lot of requests, and people asking me what the final target prices are for a multitude of asset classes and a multitude of individual stocks. Sometimes I feel like, in fact, oftentimes I feel like that's actually more of a disservice to many of you, because I think that some people hear those numbers, and one, they think that that is imminent. Like it's not just an inevitability, but it might be much more immediate or imminent in their minds, and so they place their own individual positions based upon that, even though I may not tell anybody individually what the timing of that is going to be. So I'm going to go over not all of the final target prices, but some of the target prices that I think are relevant just in terms of where we are and where we're going. But I just want to circle back. Again, started right for you guys, I think, or many of you at Silver Chartist. I think it was October of 2022. So obviously we're 3.5 years into this thing, much, much, much longer than I ever anticipated. And so I'm working much more in terms of structural inflection points where I think that there are periods of opportunity to be able to pay yourself, to be able to take profits, wait for a probabilistic correction in individual asset classes, and then redeploy that capital. Okay, so I think that I'm attempting to evolve with the market, and I'm doing that because, one, I think that is better representative and a better service when I do these market updates, to tell you kind of where we are and where we're likely from a probability perspective going to be, and then you guys can make your own decisions as to whether that makes sense or whether that aligns with your own individual analysis or your own individual expertise and your own individual financial situations as to when and where you would likely, even if it's not the final harvest, where you would individually harvest in order to effectively pay yourselves for individual profit-taking opportunities. Okay, so 3.5 years ago, the S&P 3500. I often do this, right? And I do this effectively and very, very volitionally zoom everybody out, because there's so much noise in the marketplace. There's just so much noise in the world, right? Like profound silence, I'm sure, is making a lot more sense to everybody. The louder the world gets, the more important it is for each individual person that's listening to this to quiet the world around them, to include my own voice, right? Profound silence and the critical virtue in order to remain patient and to remain seated at the table, whether the entire melt up and the entire parabola, which I think is still obviously coming in the form of what I've described as the harvest. I think that still lies in front of us. But is it 6 months down the road? Is it 12 months down the road? Is it 14 months down the road? I don't know. Like, I'm just going to be totally honest with you guys. I have extremely specific target prices for all of the major indices in gold and silver and Bitcoin and Ethereum and a multitude of individual stocks. However, I don't know when they're going to get hit. So in my mind, it's much more important to just zoom everybody out and to remind you guys of where we started, where the S&P was 3,500, where Bitcoin was at 16,000, where silver was, I believe, at $18. And like now, obviously the S&P is, as I'm doing this, is right around 7,400, which seemed impossible and completely laughable. And I have all the email traffic to still prove it from 3.5 years ago, when I said that this is going to be the most hated rally of all time. And I said numerous times throughout that to be very, very careful of who you followed. And by the way, that did not mean that you were to only listen to me, because that would be ludicrous as well. But I said, be very, very careful of who you followed, because my projection was that these markets were going to move relentlessly and ludicrously higher than anybody could have imagined. And when in October 22, everybody was on one side of the boat, so to speak, in the S&P, and everyone was thinking that it was going to go down to 3,000 or down to 2,800 or down to 2,600. And there were very, very intelligent people around the world that were predicting that. Mind you, I obviously took the bold and contrarian stance that not only was that not going to happen, but that 34.91 intraday low was the low, and that we were going to move relentlessly higher from that point forward. And if you fast forward 3.5 years and darn near close to 4,000 points higher on the S&P, you could look objectively and say the structure and the trajectory was correct. And it's taken way longer, but don't lose sight. And don't lose sight because of all of the noise on whatever CNBC or Bloomberg or Zero Hedge or wherever you grab these little data bites from, that you're going to lose sight of the overall bigger picture, which is, in my opinion, and based upon the structure of a multitude of assets and Wyckoff and a number of other disciplines, that we have a lot of work to do, and that work is going to take time. But I still think, based upon the model, that we are going to move higher over time. And I think that all the people that continue to call for a top and to continue calling me names or calling me extremely overconfident, which many people still do, even though I'm effectively, I've been saying for a long time now, I don't know the timing of this. I think that I've got a very clear understanding and a somewhat clear roadmap structurally of where these markets are going to top. But I've moved significantly further away from trying to tie both time and price together, because I think that is a total disservice, and it's impossible to do, and it's impossible to do consistently well. So with that in mind, I just want to zoom everybody out and to remind everybody that once again, and I think that this is either the 5th or the 6th time that I have done this, that I've had this influx, and I might be missing one, but I remember Silicon Valley Bank. I remember Russia-Ukraine kicking off. I remember, I think it was October 7th, the Israeli attack, or the attack on Israel and the ramifications thereof after. The yen carry trade unwind, whatever you would like to call that, and the Trump tariff. Okay, I think that's 5. Iran was now the 6th. And it's noteworthy to recognize the pattern over and over and over and over and over again. And we are now 3.5 years into this. I think there's been 6 what I would consider to be large quote-unquote events. I call them narratives. Does not make them untrue or unreal. It just means that these narratives magically appear at very, very interesting technical and structural inflection points, that effectively the market is already in a position to correct drastically from elevated and overbought levels. That's all that means. Okay, so there's been 5 or 6 of these things within the last 3 years, and 100% of the time I have an influx of emails and phone calls and text messages that come in and tell me tell me that the bust and the crash has started. And it's becoming a pattern. And it's a pattern that I think that you guys should recognize, not because you're the ones, effectively, like if you're listening to this, you may not be the ones that are reaching out and contacting me. But what I'm saying is that there are a lot of people that do so and seem extremely confident and borderline cocky. And they're telling me that, Kyle, the deleveraging that you've been predicting, or the crash, or the bust, or whatever you want to call it, this is the event that's going to send the market into the final, the tailspin that you've been describing since October of 2022. And interestingly, if I respond to them, I just say, I don't think that that is going to prove itself out. It's not a I'm right, you're wrong, even though they're telling me from their perspective that I'm wrong and they're right. I just take a very measured, very pragmatic look at the markets, and I look at what the structure appears, and then make a determination from a probability perspective. Well, I don't think that's actually the case. So, case in point, I believe that the sixth narrative, sixth events that is currently taking place and began, I think it was at the end of February, was the quote-unquote attack on Iran. And regardless of what you think about it, I have no doubt that everybody listening to this or that will listen to this has their own opinion, and I don't think you guys care one iota of what my opinion is on the entire thing, nor should you. But what is relevant is that you should note the pattern, and that I, in fact, I wrote on X, and I apologize that I don't have this completely, I'm looking for it right now. Many of you have inquired about the war in Iran and its implications on the markets. Many understandably are concerned and fearful. I tend to stay quiet on things I'm not an expert in, to include Middle East foreign policy, the Strait of Hormuz, or Iranian nuclear capabilities. I believe that you can find more than enough experts on X for that. Once I complete the Q2 fund quarterly, I will be providing an update for you later in April. Here we are on May 8th, so I'm a little bit behind, where I will be discussing the volatile and challenging financial landscape that you're experiencing. For now, I would like to focus those of you that are concerned specifically with Iran on what I wrote, and this is relevant to you guys, on December 27th, 2025. So I'm now going back to something that I wrote in December, at the end of December, for limited partners regarding the S&P and accompanying US indices. And I quote, this is what I wrote. I am observing something coming later in February or early March that will fill the required narrative for a tree shake by the market makers. I do not know what it is, but I can see it in the structure. It is not in your best interest for me to attempt to project the event. I only bring this up so that once we get there, you are not surprised. End quote. I wrote that on December 27th, 2025, not having any idea that it was going to be an attack on Iran. Zero. If you would have given me the opportunity to maybe even throw a dart at a dartboard or guess as to what the event was going to be, it would have been a zero probability that I would have guessed, well, it's going to be Iran, right? I don't know what it would have been. I wouldn't even hazard a guess. My point is that you can see, if you know what to look for in the structure, you can see, and I know that most people don't believe this, and that is completely fine, but you can see very large events within the structure or the body of an organism before it happens. You don't necessarily know what it's going to be, right? Just like when COVID happened, there were many people that looked behind the curtain and were like, there's something not right. There's something happening in the LIBOR market in the middle of the night while everybody in the US is sleeping. And why is the Fed or its proxies sending hundreds of billions of dollars over to Europe in the middle of it? Like, there's always signs. There's always something within the body of the structure of whatever underlying asset that you're looking at that gives you clues. It doesn't give you a 100% probability. Nothing in the market is 100% probability, as you guys know, right? But it gives you clues as to there looks like there's something coming around either a certain period of time or a certain level. And I call those inflection points. And I use the word narrative in order to describe what it is, because I don't know what the event is going to be. I just can see it in the structure, in the living organism that is the S&P, or the body of whatever structure that I'm looking at. Okay. So what are the chances? Like, what's the probability of me being able to write something on December 27th about something that is going to take place in late February or early March? What's the likelihood of me being able to guess that? I don't know, but it's really close to zero. And yet I did that basing my credibility with the limited partners of the fund in order to let them know ahead of time something is coming. I don't know what it is, and I'm not even going to hazard a guess, and it's not even worth my time, certainly not your time, to try to see into the future with some muddy crystal ball as to what's going to happen before it happens. That's not the lesson here. But the lesson is you can see things if you know where to look, okay, and with what lens you're looking through that. Okay, so fast forward to, I believe, I don't exactly remember the date of the attack on Iran, but I believe that it was like February 27th or February 28th. Very much in line with what I said, late February, early March, within the body of the S&P, or the body of that structure of the US indices, okay? So further, in my opinion, we are at a similar, not exact, state of fear, uncertainty, and doubt that we were in with Silicon Valley Bank failing, the Russia-Ukraine war, the yen carry trade unwind, and the tariff tantrum. Okay, so now that we have 2 or 3 months, let's see, 2.5 months since the US attacked Iran. And again, whatever you think of it, whatever your opinion is, I'm not even here to have that conversation. That's another conversation for another day. But now that we have the hindsight of 2020, looking back to the end of February, we were, I believe, right around 7,000 in the S&P. And we went all the way down to 6,300, I think around a 10% decline. And again, right around the bottom, a multitude of emails and phone calls and text messages, influx, pattern recognition is important to note. Right at the bottom is when you get this influx of people that are convinced that that was the start of World War III, and thus the start of the deleveraging and the crash and, the worst financial event since the Great Depression. Fast forward from February 27th to May 8th, as I'm here, a little over 2 months, we have had one of the most aggressive and quick rebounds in modern market history within the S&P US indices and a lot of other indices around the world, if you're paying attention. The S&P has gone from roughly 6,300 to roughly 7,400 in about 5 weeks. That is an incredible move. So if you're looking at this from a pattern recognition standpoint, because I'm bringing this up because this isn't going to be the last one. There's going to be more narratives. There's going to be more noise. Remember what I said from the very beginning. This is going to get tougher as we get closer to the top. And the tough part is more noise, more events, more narratives that are going to convince you that this is the end, this is the start of the bust. And oh, mind you, it's not going to be me, but you're going to have all sorts of other analysts and experts that continue to tell you this is the top, this is the top, this is the top, consistently, consecutively, repetitively. And they have followings that have, I closed that Twitter account, I don't know, years ago. I have 500 followers that whoever was following me at the very beginning came over and I closed it, and now it's a private account. Again, I'm not trying to build a name, I'm not trying to build a brand, I'm not trying to build recognition. Okay, this has nothing to do with that whatsoever. But you've got people with tens of thousands, hundreds of thousands, or millions of followers that continue to place people, whether it's unintentionally or intentionally, it doesn't matter because it's effectively the same end result. They continue to place people offsides and off bounds. And I know that with 100% objective certainty because those people are the ones that continue to reach out to me at very interesting inflection points in the market. And they are convinced, just like they were last month at March 30th or April 1st or whatever it was, around 6,300 on the S&P, that we're going lower. That's the start of the bust. That's the start of the crash. That's the start of the leveraging because this person on X said this. X amount of trillions of dollars just vanished from the equity markets, right? The pendulum swinging very violently back and forth. Another analogy is placing you completely offside and off balance, which is why I wrote that 3 years ago or whatever. So you can see it, pattern recognition. See the pattern. It happens over and over and over again. This becomes, I'm hitting this really hard at the beginning of this video because this is really important. Because as I described 3 years ago, this becomes harder, not easier, as you move up what will eventually be, in my opinion, a final parabolic blow off top in a multitude of asset classes, mind you. This is the grand ballroom. And we have a long way to go in terms of where we are and where we are going, in my opinion, in gold, in silver, in the S&P, in the Dow, in the Russell, in Bitcoin, in Ethereum, in a multitude of asset classes. And they're all running at different periods of time so that it confuses all of the people that are following it thinking, this doesn't make any sense. Why is this happening at this, it's not meant to make sense. It's only meant to draw you in at the very end while you FOMO into the parabolic blow off top, while you allow them to extricate their positions on you, your liquidity. They don't care if you participate in the melt up. Their only point is to bring you in at the very, very end, to trap you at the top. Okay, I think I talked about that like ad nauseum many years ago, but it's a reminder psychologically. This pendulum, this pattern recognition of moving up into a structural or a technical inflection point and then dumping the market based upon this narrative, based upon Silicon Valley Bank, based upon Ukraine and Russia, based upon Israel, based upon Iran, based upon Japanese yen unwind, based upon Trump's tariffs. Okay, it's not the narrative. It's all in the structure. And if you can recognize the pattern that continues to play out, you will then be able to see, not like you can't see into the future. I can't see into the future. It's not what I'm attempting to do, but it's pattern recognition over and over and over and over again, right? It's just rinse and repeat and use a different narrative in order to place offsides and off balance, and then to run the markets in the opposite direction. Get everybody to basically sell their positions, most recently at 6,300 on the S&P, and then what? Have them rebuy back. Have them rebuy it at 74 or 75 or 78 or whatever the number is until the next inflection point is hit, and then they use a different narrative, and then the market's correct, and then we do this all over again. Okay, so that was way long of an introduction, but that's the body of this update. I know most people want to know, Kyle, what's your opinion on where gold is going to go or where silver is going to go? Like, that's all good and that's all important, but don't lose sight of recognizing the pattern that they're using over and over and over again so that you can make better decisions at highs or intermediate term highs or intermediate term lows. And just be really, really, really careful. Like, I don't post a lot, and I don't do these video updates a lot. Like, I think less is more. I continue to say that over and over and over again. I think that there are people out there, a lot of people out there, that it's more content, that it's more of this, that it's more of this, and they think, and maybe rightly in their own minds, that they think that that's adding more value to you. I don't honestly agree with that. Now, are there people, are there analysts, are there experts that are doing that and are providing value to their subs, to their clients? 100%, of course. Like, I'm painting with a broad brush. But you guys send me things from different people, different voices, and so I try in my own timeline to listen to whatever, if it's a podcast or if it's, oh, this letter over here, this letter over here. Like, I'm doing my thing, and if I allow too many voices in, and if I allow too much analysis in, it completely bends my own bias. And my own bias is based upon these different disciplines that I'm using in order to effectively come up with this model. And so if I introduce too much noise in my own life and I don't use profound silence, what do I get? I get everyone else's opinions but my own. I get everybody else's analysis but my own. And I think that it's important not to listen to me. What I've said from the very beginning is that it's much more important, and you guys will remember this, it's much more important to understand how I think than what I think. That still is true. It was always true. It was true 3 years ago. It's true now. It will be true into the future as I move into, I think, what will be considered the harvest period down the road. So, okay, so that kind of sets the stage for like where we are. We are in the S&P. Overall, I'm not going to spend a ton of time on the actual target prices or the updates. I'm just going to run through this really, really quickly because I don't want to take up any more of your guys' time than I think is necessary. We talked about, or I think I put out something last time about the top in silver. Now, very few people wanted to hear that, just like every single intermediate term top or every single final conclusion top, right? In the Q1 quarterly, I had projected silver to hit 118 to 136. Now it came much sooner than I thought that it was going to, but I think that it hit 121, 122, depending upon what indice you're actually looking at, but that fell within the 118 to 136 range. I think I said on Twitter that from that point, we're going to get a massive correction. And on a high time frame, if you're looking at it strictly from Elliott wave, that would have been 4. And now we're going to move into a 5. However, anytime I say, and I'm using Elliott wave, realize it really depends upon what time frame you're looking at, whether it's a low, medium, or high time frame. If it's a high time frame in terms of view from 30,000 feet, that correction from 121 back to 60, or whatever the number was exactly, I don't have it in front of me. That was the wave 4. Now, it happened just like that, as opposed to other markets that can take weeks, months, or even quarters to complete a high time frame wave 4. We got that rather quickly in both gold and silver. Okay, so I know a lot of people, obviously, especially from silver chartists, are interested in, and these are and likely will be revised. I'm not going to say that they will with 100% certainty. I don't know that. I don't like to speak about things that I'm really inconclusive on. So I will give you the most recent gold silver targets gold. I raised that 5 months ago to gold 7,600 to 8,050. I raised the silver target to 206 to 234. Can that be changed? Can that be revised either upward or downward, depending upon a multitude of things? Yes. But right now, as we are talking, May 8th, 2026, those are the gold and silver targets. Those are the final targets in the melt up. 7,600, 8,050 on gold and 206 to 234 in silver. Like I said, can those change? Yes. Doesn't mean that they will. It just means that they can. As the market evolves, I have to evolve, right? I think Steve calls it the Bayesian approach. Okay, which is true. It doesn't mean that you're just locked into one number or one range. It means as the body, like as I think the Bayesian approach is, if new information or as new analysis or as whatever, as new things come to you, you evolve with that new information. Another way to say this is as the structure of the body of the asset class that you're studying, as that body evolves, as that body changes throughout a period of time, you change or your analysis changes with that based upon the evolution of that body or the evolution of that structure. It's just a different way to say the exact same freaking thing. Okay, all right. So that is that for gold and silver. The S&P, I've talked about that before. It's I think, and I apologize because it's I don't ever listen to the old video updates. So I'll just go with, I'm looking at the Q1 fund quarterly. Speaking about the S&P, it says it will be sharp and fast, but according to the model and the structure, there lies one final parabola. If this proves to be accurate, the final impulse will take the S&P to a range of 9,170 to 9,520, with an outside chance of 9,760 being hit. As always, I will be very closely monitoring the embedded energy within the structure of the S&P and will update all of you accordingly. Okay, so that was written December 27th. Well, I should say I started writing the Q1 quarterly for the fund December 27th, 2025. So I have not updated the structure of the S&P since that time. It doesn't mean that it hasn't changed. I just have not updated it. Okay, and if you were to have emailed me and known that information and emailed me about a month ago when the Iranian situation was on the surface getting completely out of hand and we were on the precipice of a ground invasion and the 82nd Airborne was going in there and fertilizer prices and energy prices and the Strait of Hormuz and Carb Island and all of the other things that you were hearing, like if you were to have emailed me knowing this information, you would have called me an idiot. Okay, there were people that emailed me and said I was plain wrong in my analysis of, and these are people in the fund, mind you. Okay, and they're entitled to do that. That is completely fine. But interestingly, they're very quiet right now. So sentiment changes very, very fast. And it will continue to change very, very fast, which is what I have projected from the very beginning. They will not make this easy on you. This is going to be a game of placing you very intentionally offsides and off balance multiple times throughout the entirety of this final cycle. And I think, very objectively, they've done an extremely good job of doing so up to this point. Okay, and not just in one market, in a multitude of markets. Gold and silver being, I would say, the most recent example of that, where they convinced you that, they convinced many people on X that due to the supply constraints in China and this narrative, that silver, especially silver, was in a supply deficit and it was going to go to $200 or $300 or even $500, which was laughable if you just look at it from a structural perspective. But they were convinced, right? Never mind you that they've only been in the market for 1 or 2 or 3 years, right? Like maybe don't have that, that attitude when you're not exactly a seasoned veteran watching these markets over and over and over again for 15, 20, 30 years. Okay, so the S&P 9170 to 9520. I honestly don't know if I told you guys that before. Outside chance of 9,760 being hit. Again, I have not updated that structure in 4 months. You may be asking why? Because we're so far away from the final. In my opinion, in the model's opinion, we're so far away from hitting what I believe to be the top that it's not really relevant in the immediate term to constantly tweaking these markets. Well, it's going to be this. It's going to be 9,100. Well, now it's 9,500. Now it's 9,800, right? Because then people say, why do you keep raising or why do you keep changing, your overall final target price? It's because as the market evolves, so must I. But I don't need to do it on a daily or weekly basis when we're this far away. Once we get closer, I believe, based upon past experience, you can see things much clearer as you get closer to the final move in the market, right? Or an intermediate term move in the market. I think the most relevant example of that, practically speaking, is silver in the last run-up in late December, January. Like, yes, did I have 118 to 136? Yes. Did it fall within that window? Yes. But strictly from a psychological perspective, at sentiment level, you knew that as we were blasting through 100, we were getting quite overbought. I can't remember what exactly the number was on the RSI on the weekly. I think that it was 97. Don't quote me on that, but it was extremely high, right? And it doesn't mean that obviously it can't move higher in the short term. Like, just because something is overbought, does that mean that it can't continue to be overbought? No, of course not. But it just means that the embedded energy within that structure is losing energy even though it continues to move up. Okay, so I think that's a practical example of where we are right now. And so the majority of the market, or many people in the market, thought that silver was just going to continue to blast to 200 to 300. I know that because you read it all over the place, right? People were convinced of it. And obviously there were analysts out there that were calling for the opposite and saying, no, we're actually getting closer to a near-term top. And this is probably a good profit-taking opportunity, at least in some of your overall portfolio if you're exposed to precious metals. Okay, so I know people are going to be interested in Bitcoin. So Bitcoin's always tough. It carries the highest volatility it has since it was created by someone back in 2009. That's the design, that's the creation, that's the architecture of the entire thing. So overall, one of the big takeaways is that I think that we are, short-term volatility aside, like short-term movements, which you guys know that I'm not a trader, so I'm not trying to catch every single swing trade back and forth. So barring shorter term weakness based upon where we are on an overbought level, I think that we have a period of likely 2 to 3 months in several, or I should say maybe more than several asset classes to include the US indices, Bitcoin, gold, silver, that we've got a pretty strong move ahead of us. Now, not strong in terms of what we have just experienced in the last month, right? Like 6,300 to 7,400 in the last 5 weeks is a pretty incredible move by any metric. So it will probably feel less, if you want to consider euphoria, you're euphoric. Like, we're not going to have the amount of implied volatility that we've had over the course of the last 5 weeks over the next 2 or 3 months. But I think if you are looking at the overall trajectory, I think that the body and the structure of a multitude of assets looks very healthy as I say this on May 8th. Now, does that mean that it can't change? No, of course not. And again, if it changes and it evolves, then I will at least post something on X that, hey, I don't like this look, or or whatever. But overall, I think over the course of the next 2 or 3 months into summer, say potentially July, late July, maybe early August. And again, don't get so locked into Kyle said this, it's going to be late July, early August. I'm just using that. I'm speaking to you on May 8th, knowing that I can't time this in terms of where or when it's actually going to hit a certain technical point. But I think that we have a season of continued upward trending markets over the course of the next 2 or 3 months. I've been saying for a long time that this will be a period of, it's not the harvest, but it's a harvest. And what I mean by that is that I don't think that this is the final top, but I do believe that it is an intermediate term top within a multitude of asset classes, that it's worthy to consider taking profits, especially for people. And I know these people because these people and I have discussions about this. If you are living on a fixed income, or if you're living maybe without a dedicated paycheck that you can count on every single 2 weeks or every 4 weeks or whatever, I think that we're approaching in 2 or 3 months a period of harvest that you could pay yourself, that you can give yourself a little bit more of a runway before a technical and structural correction in many markets that I think will take place into the fall. But right now, I think that overall the trajectory, and again, barring some short-term volatility, I think the trajectory is up. Okay, so I can already hear the questions. Kyle, what does that mean? Does that, what's the level that the S&P is going to get to, in July or July 15th or August 1st or whatever? And the answer is I don't know that, but I can see a scenario and I can see in the structure that it looks like the S&P can get to somewhere between, potentially like 7,650 and 7,900, which doesn't sound like that much when we're talking about 7,400 today on the 8th. But again, we're building kind of a sense of euphoria. We're not euphoric right now. Like when I just look objectively across the board, we're not in euphoria. We're in kind of like that period of like we're traveling up that wall of worry. It's almost like disbelief. Like, how is it possible that everything's going on in the world right now, with AI and the destruction of a lot of white collar, and mainly white collar jobs. But like, remember what I told you 3 years ago, or at least I tried to communicate, is that for periods of time, you can have rapidly deteriorating physical economies and a complete disconnect in capital and credit markets. And so if you fast forward 3 years from where we were, has that played out? And the answer is yes. The physical economies around the world, roughly speaking, have continued to deteriorate. All the while, a multitude, in fact, the majority of the mature equity indices around the world have continued to move relentlessly in grinding fashion higher and higher and higher and higher. Okay, and I know that sometimes I continue to focus you guys on whether it be Japan or whether it be the South Korean stock market. If you were to overlay the body, not the chart, but the body or the structure of those two asset classes on top of one another, you would realize what I was saying 3 years ago is that roughly speaking, the U.S. equity markets is somewhere between 2 and 6 months behind a lot of the major other international equity markets, to include the Nikkei 225 and the Kospi or Kospi, whatever they call it in South Korea. Okay, so I am expecting that we have a pretty strong 2 or 3 month period going forward in a lot of asset classes. I don't have the structures built out as to, well, what's gold going to be, or what's silver going to be, or even what Bitcoin is going to be. I think that the S&P has the capacity to get somewhere between 7,650 and maybe 7,900, 7,950, something like that range in July or August. Maybe as early as early July, but maybe as late as early mid-August. Okay, I don't know that yet. I think Bitcoin has the capacity to probably in that same time period. I mean, and I know a lot of people, to include myself for that matter, have been disappointed with its performance. But remember what I said from the very beginning is that they're only going to recorrelate the S&P and Bitcoin at the very end of the cycle. And what does that mean? That means that the S&P has its leading in terms of its structure. So the grand ballroom idea is that you've got all of these different asset classes: gold, silver, precious metals, some other commodities, platinum, obviously. I think uranium has done well. I'm not really even following it all that well, but it will do its thing. International equities, U.S. equities, Bitcoin, and you've got all these different tables in this grand ballroom. And during the euphoric part of the move, it's all extremely loud and it's all extremely boisterous, and everybody's making a ton of money. And you don't really know that you're sitting in this grand ballroom, and this grand ballroom is being controlled by the market makers, and the market makers have you exactly where they want you. And the music is about to stop, but you can't hear the music stopping because you're so loud and greedy and euphoric in your own individual asset class, be it gold, silver, Bitcoin, S&P, whatever, that you don't understand what's happening around you. And that's the big picture of what that grand ballroom idea looks like, right? And then the music does stop, and they have you exactly where they want you, and they've trapped you at the top in your positions, and you're not going to be able to get out in time. So going back to Bitcoin, structurally, it doesn't look great, honestly. But I say that with good and bad news. The bad news is that it's dramatically delayed in terms of the structure. If you were to overlay Bitcoin and the S&P on top of one another, the structure of Bitcoin is dramatically lagging the S&P. But that's what I've said from the very beginning, is that they're only going to recorrelate those two markets at the very end, because you guys will be like, well, Kyle, you said that once the melt-up completes, that the S&P or tech, it's just a proxy for tech, or the NASDAQ, that tech and Bitcoin are going to peak extremely close to one another, like as in within weeks, would be my guess, and has been my guess for over 3 years. I still think that is how this entire thing is going to take place. It's just that Bitcoin, structurally speaking, is delayed in the sense where they're going to recorrelate it at the very end. And the intention behind that is to keep everybody guessing, is to keep everybody offside and off balance. So do I see a period of higher highs, or I should say, of an upwards biased trajectory over the course of the next 2 months, 3 months, maybe into July or early mid-August? Yes, I do. At this point, I still really only see about somewhere around 95,000 on Bitcoin at that point. I would love to be wrong, and I would love for it to be higher, obviously, because I do have some exposure personally, and I do have some exposure within the fund to what people consider to be Bitcoin miners. And I think that I've tried to explain myself quite frequently about what I consider to be Bitcoin miners, and how all of them, at some point or another, are going to pivot from a business strategy perspective, pivot to energy and technological infrastructure for the ascending AI narrative, which is why I keep reposting effectively the same thing over and over as each individual equity is re-rated because of their business strategy to high power computing, okay, with their hyperscalers. I think the most recent examples that I've been giving are TeraWulf and Hut 8, but you can see it across a multitude of what people considered 3 years ago to be Bitcoin miners. And I said, if you stop worrying overly concerning yourself with the day-to-day or week-to-week fluctuations of Bitcoin, and realize, like skating to where the puck is going, that everybody thinks, or the majority of people think, and rightfully so, that AI is a bubble. Unfortunately, for most of those people, they've sidelined themselves and they think that it's a bubble that's about to pop. But what if it's not ready to pop yet? And it continues to grow and grow and grow and grow. And people that are perceiving these Bitcoin miners to be only Bitcoin miners, when in reality, they're commodities. They're energy companies. They're providing the energy requirements that are needed in order to fund the technological ascendancy of artificial intelligence and high power computing within the hyperscalers. Okay. So that is a very, 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 very important point that I think is kind of being lost on a lot of people. Like, well, how come Hut 8 is doing this? Or how come TeraWulf is doing this? Or how come IREN Energy or Cypher Mining? How come their stocks have re-rated in Riot or Marathon or CleanSpark have not? The simple and correct answer is their structures are dramatically lagging the rest of those four individual companies. The answer that the market perceives to be accurate is that they have not yet pivoted their business strategy to AI and HPC, which is also accurate, but it's just a narrative that is going to be used for the structure to be fulfilled, if that makes any sense. Okay, so Hut 8, TeraWulf, IREN, Cypher. Are these Bitcoin miners? Well, they were perceived, at least 3 out of those 4 were perceived to be legacy Bitcoin miners 3 years ago. But about 2.5 years ago, I started floating or planting the seed in anybody that want to listen, that these were not Bitcoin miners, that these were energy companies. They're energy companies. So anybody that's investing or wants to invest in an energy company, whether it's oil or whether it's uranium or whether it's something else, an asymmetric view then and still now is that there is not enough power from a megawatt perspective around the world, but seriously within the US right now, in order to fulfill the already present requirement of the hyperscalers. It's not even close. The disparity is massive. And so I took a position. I took a position with my own money. I took a position with the fund and acting as the general partner that even though, largely speaking, it can be viewed as a commodity fund or a precious metals or a natural resource, I looked at it definitely from a contrarian perspective, but definitely with a lot of asymmetry already embedded within that bet, is that 2 or 3 years ago when I was buying these things, it was viewed as they were Bitcoin miners. And my point from 2 or 3 years ago is that that's fine that you think that they are Bitcoin miners, but what I see is they're energy companies. They're going to provide, and I even wrote this, I've written this multiple times on X and posted it, and this is important to reiterate because skating to where the puck is going to be, not to where it is right now. Where it was then 3 years ago was that they were mining Bitcoin. So Bitcoin price goes up, it probably leads, and it's just it's a leverage play on the underlying proxy of what Bitcoin is. Okay, and a lot of people are like, well, I don't like crypto, and I don't like Bitcoin, and I'm like, okay, that's fine, but maybe look at it from a different perspective in the sense of not where it is, but where all, and I do mean all of these companies are going to have to transition in order to move their business strategy from one of net neutral on a balance sheet to net positive. And I'm not talking about strategy or just like a Bitcoin treasury company or an Ethereum treasury company. I'm talking about technological and specifically energy companies. And the TeraWulfs, the Cyphers, the IRENs, the Hut 8s, and soon, in my opinion, when I mean soon, I mean within the next year, right? Like I'm a longer term investor and I don't know, even when I talk to the C-suite of a lot of these individual companies, which I do, mind you, they don't say when this is going to happen. They give you hints and they give you clues as to their shift or their pivot in the business strategy of the individual companies. So that I can't say, and I wouldn't have said 2 years ago when I was buying Hut at 9 and 8 and 7, that Hut 8 was going to be, largely speaking, the fastest one out of the gate. I wouldn't have known that, right? Because for the majority, the structures, relatively speaking, all looked the same. Now, yes, did they change? Yes, of course. But at that time, when you're just looking at individual assets or individual stocks within an asset class or a vertical, you're not going to be able to guess, well, Hut 8 is going to move first, or TeraWulf is going to move first, or vice versa. Riot or Marathon or CleanSpark, they have, they're all running different stocks in different asset classes at different periods of time, again, to create confusion and to keep people completely offside and off balance. So, but I just wanted to bring that up because I get a lot of questions about, like, why do you keep talking about these things? Why do you keep talking about Hut 8, or why do you keep talking about TeraWulf, or why do you keep talking about the Bitcoin miners? They've been so, Bitcoin has not done, what you have projected to do. And mind you, I agree with you in the sense that it hasn't done what I thought that it's going to do by now, but that does not mean that they will not recorrelate Bitcoin to the NASDAQ, or that they will not recorrelate Bitcoin to the S&P, because I believe that they will, and I believe that they will likely and largely do so at the very end of the conclusion of the cycle, which you will know as the parabolic blow off top or the harvest. Okay, talking about that for 3 years. But why have I largely blended within my own, managing my own money and then managing as a general partner of the fund? Like, why have I chosen mainly gold, silver, and the likes of Riot, Marathon, Hut, TeraWulf, Cypher, IREN, CleanSpark? Like, why those companies? Like, Kyle, it's theoretically, it's a commodity fund. Okay, or you're managing your own money. Like, why are you buying these things over here when Bitcoin isn't necessarily doing what it's always done? And the projected target prices is because even though everyone is looking and viewing and perceiving these things strictly from a perspective as they are a derivative of Bitcoin, realize that it's not like, that's not why I'm investing in these things. They are energy companies. Whether you like AI or whether you do not like AI, that is a totally different topic of conversation for another day. But realize that what already is in place, it's not the bubble that continues to grow. And in my opinion, it will continue to grow to levels that people still can't imagine yet. But that's not why I'm investing in those things. It's because if you look at it just strictly a supply and demand perspective of megawatts needed and megawatts available, there is a massive disparity between the two. Okay, oil is not going to fix it. Uranium is not going to fix it. Okay, these companies are specifically able to pivot from Bitcoin mining into AI and specifically high power computing quite quickly. And they have the executive boards and they have the knowledge of building these things out in a relatively short period of time. But they've got the subject matter expertise and the knowledge to do so. Okay, some are quicker to do it, and rightly, their stock prices have re-rated dramatically over time. I think that I probably brought Hut 8 to your guys' attention over 2 years ago when it was at somewhere between 6 and 10. I think that's close to 100 right now. Same thing with others. And there's a lot of people that are still like, well, why, again, why hasn't Riot done this or Marathon done this or CleanSpark done this? Just because they haven't doesn't mean that they're not working towards that end goal. And as that end goal is met, and if the market continues to move higher over a period of time, which I believe that it will, then we're not done. And those stock prices will re-rate. Now, will they re-rate to the same levels as Hut 8? I don't know. We'll see. I think it largely depends upon a lot of different things that haven't taken place yet. Okay, but that's the bet. That's the asymmetry. They're not Bitcoin miners. That's what everybody perceives them, or that's how everybody largely perceived them 2 or 3 years ago. But that's why I brought to your attention, not to skating where the puck is at that point, but skating to where the puck is going to be, and where the puck was going, and where it is currently, is the disparity of power between what these hyperscalers need and what they have physically accessible to them right now. And there's a very large disparity between the two. So if you think about it from that perspective, do you care when you're valuing a company based upon the price of Bitcoin, or are you valuing the company based upon a different metric that would be more applicable to other energy companies? Well, I think the latter, because I look at these things more as energy and technological companies than I do as just proxies of Bitcoin. I said 3 years ago that I think that they will have the tailwind in hindsight of having a 6-digit Bitcoin price as a tailwind, but I think that was the incorrect view. I think that people should look at them as energy companies with a tailwind kicker of having a 6-digit Bitcoin price. And I still hold that to be true. And I still think that there is a lot of upside potentially over the course of the remaining part of the harvest, or I should say of the melt up. Okay, because I don't think that we're there yet. So largely speaking, S&P, gold, silver, Bitcoin, some of the individual stocks, more so bigger picture. I just want you guys to see pattern recognition. That's like, in my mind, that's one of the bigger takeaways. It's not the individual. I know everyone, Kyle, what is your target for gold or for silver or Bitcoin or the S&P or all these different asset classes? Like, that's fine, that's great. I think that they can change over time. They can evolve as the structure does. But I think what is much more important to recognize is the pattern recognition of how the market makers are actually moving this market. Basically, offsides and off balance, swinging the pendulum back and forth, short-term euphoria, short-term fear, placing everybody, or I should say, placing the majority of the market offsides at technical and structural inflection points. They introduce a narrative. Doesn't mean that the narrative doesn't exist. Iran very much exists. The conflict or the war, whatever you like to call it, that exists. It's real. Same thing with the yen carry unwind or Silicon Valley Bank or Ukraine, Russia. They exist. But interestingly, they're introduced at very coincidental, I'll just call it coincidental, timelines where Wyckoff dictates that there should, from a probability perspective, not 100%. I've never said that this is 100%. But what I have said, just like every other good analyst, mind you, says this is a game of probabilities. So when I'm looking through the lens of Wyckoff on a high time frame, there are technical and structural inflection points that allow you as an analyst, if you know how to use that discipline, in order to look through that lens and say there's a better than 50% chance that in this range of whatever vertical that you're looking at, the S&P or any other asset, that this is a period or a structural inflection point that looks to be what I consider or call a tree shake. The market makers can shake the tree. They can introduce a narrative that will fulfill the already existing overbought and ready for a technical correction structure. That's always what I've meant. Okay, so it's important to recognize the pattern that is being played over and over and over again. So that's all I have. I will hope everybody's doing well. Profound silence, critical virtue. Do not lose those two things. It is going to become louder, noisier, more violent. Everything becomes, as time compression happens towards the end of the cycle, and if this model is correct and we do end up going into a parabola, what I've long thought was going to be the culminating event, the harvest season, so to speak, all of these things that I've said years ago, I think are going to become really, really important. Okay, and I think that those two, again, are your superpowers against what I've described as the market makers. So being patient and tuning much of the world and much of the noise and much of the signal out from your world. Okay, again, it does not mean listen to me and listen to me exclusively, because look, I very rarely post on X, and I very rarely do these updates, and it is for a very intentional and volitional reason, because I don't think that it serves you well to constantly get more. I think less is more. So with that being said, what you guys can expect from me going forward is when I believe that we are close to an intermediate term top, like whether it is in July or whether it is in August, I do not know. But as we approach what I consider to be a profit-taking opportunity, I will say that. I will both post it on X, and I will likely do another one of these, only it will be much shorter and much more concise as to, hey, here's where I think that we're at. I think that we're real close. So if you need funds, or if you would rather not participate in a large market decline, now would probably be a time to consider trimming whatever positions that you have that you would like to, in order to place yourself in a better mental emotional state. Okay, so I wish you guys all the best, and I will be back with you as needed. But I hope everyone's doing well. Hope you guys are enjoying spring. If I don't talk to you until July or August, hope everybody has a wonderful time start to their summer and summer plans with family and friends, and I will talk with you soon.